Hi, welcome to today's video. We're going to talk about closing entries, and we got a lot to talk about, but closing entries generally are fairly easy for the accountant to do. So it's not as hard as adjusting entries, so you're probably going to say thank goodness. Okay, some facts about closing entries. The purpose is to set to $0 the temporary accounts and to adjust retained earnings or JADO capital to its correct year-end value. So essentially, we're closing the income statement and the statement of owner's equity and preparing the balance sheet. So we're setting all the temporary accounts which are on the income statement and the statement of owner's equity to a zero value and updating or adjusting retained earnings or JADO capital to its correct year-end value. That is the purpose. There is an order to closing. We close the revenues first because that's the first thing we see on the income statement. Close the expenses second. Close the net income or loss third, and then close dividends or drawing last. And of course that depends on the type of a business. What are temporary accounts? They're non-permanent, meaning that they are temporary. They will go to zero at the end of the year. Those include revenue, expenses, income summary, dividends, and drawing. Permanent accounts always maintain a balance. They are never closed. They include assets, liabilities, and most owners' equity accounts except dividends and draws. Income summary is a temporary account that's used only during the closing process. It essentially holds the revenue and expenses and eventually will close that income or loss. So it really does hold the net income or loss for a period of time. An example of the closing entries are here. First off, we'll title the area closing entries, and that is good enough for an explanation, so you don't need an explanation in the journal. We'll debit our revenues, credit our summary, and there could be several revenues. By debiting the revenue, that sets the revenue, in this case sales, to zero, and we credit income summary. We debit the income summary to get rid of our expenses. So we'll debit rent expense, wage expense, pardon me for not writing it out, I'm out of board space here. There could be several expenses. We add them all up, we then fill in the number for income summary. So you don't just fill in the number, you add them all up and then put that number in. Then, since income summary had a credit of 10 and a debit of 2, we have to set that to 0. So we're forced to debit income summary to make it 10 on the debit side, 10 on the credit side, and a 0 balance. We will then credit retained earnings. And the last thing is we debit retained earnings and credit dividends. That closes the dividend account. Now, in the case of a proprietorship partnership, that would be to debit JADO capital and credit JADO drawing. So that would be the difference there. And in the case of this third entry, in a proprietorship partnership, that would be, again, JADO capital. So, what have we learned? In closing entries, they're pretty simple. The purpose is to set to 0 the temporary accounts and adjust retained earnings or JADO capital to a correct balance. There is an order: close revenue, expenses, income summary, dividends or draw. The temporary accounts are the revenue, expenses, the summary, the dividends or draw. They are set to 0 at year-end. The permanent accounts always maintain a balance. They're your balance sheet accounts, assets, liabilities, and equity. And here is an example of the closing entries. I hope this helps you to give you a little bit of a glimpse into that world. We'll see you in the next video. Take care.